Learning to trade cryptocurrencies takes time and work, just like learning any other business, but it may be rewarding for successful traders, especially those who want to be their own boss. We have already posted a video on what are day trading and long-term trading. If you have not watched the video yet, click on the I button on the right top corner of the screen. Today's video is about benefits and drawbacks of day trading as well as long-term cryptocurrency hodling. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex and many more. So watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So let's begin the video. Benefits of day trading. Investors have the freedom to define their own objectives and speed. There is no overnight danger, which is present, particularly in the trading of stocks and commodities. A chance for large profits and the best circumstances for leveraged holdings. The potential for profitable investments even during downturn times. Quicker investment returns. Deals can be profitable with only a few early morning trades for disciplined and experienced traders, for example, leaving them with the rest of the day free, and since there is a lot to learn in technical and fundamental analysis for the curious and questioning mind, the learning curve may be unlimited. Drawbacks of day trading. Asset allocation for day trading may be excessive. The first investment guideline should also be used in day trading: never put money at danger that you can't afford to lose. Implementing self-discipline can be challenging. Day trading can be extremely profitable, but it can also result in large losses. Continuous market monitoring, long periods of time spent staring at a screen, can be tedious and isolating. Stop losses can be useful, but they are not long-term answers. Day trading can be stressful because of the high stakes and erratic nature of the cryptocurrency markets. Since day trading necessitates maintaining accurate records of all transactions, tax compliance can be difficult. Therefore, investors must also be their own accountants, which might take a lot of time. Hodling cryptocurrency is a long-term approach that may offer a safer investment choice, particularly for novice asset owners. Financial markets frequently use the phrase "sit back, relax, and go back to your investment in 5 years." And the cryptocurrency sector is no exception, because hodlers also live by this maxim. Benefits of hodling. Hodling eliminates the requirement to continuously monitor pricing actions. By hodling, investors boost their likelihood of benefiting from long-term value appreciation while avoiding the stress and risk of coping with short-term coin volatility. FOMO and FUD-type emotions are minimized. Hodling can produce enormous returns, usually in the span of just a few years in the cryptocurrency world. For instance, the return would have been close to 1,100% if you had purchased Bitcoin in the spring of 2020 at around $5,500 and sold it in the autumn of 2021 at around $65,000. With any other asset, it's quite unusual to earn such a significant return on an investment in just a few months, and investors can postpone paying taxes by hodling. In the event that the value of the cryptocurrency keeps increasing, they can retain more money invested and boost their chances of growing their capital much faster. Drawbacks of hodling. It can be challenging to ride out downturn markets, therefore investors should resist the urge to sell, especially at a loss. Investors must make sure they have enough capital available in the event of forced sales or unanticipated liquidity demands. Still, hodling can be dangerous. Although some cryptocurrencies, such as Bitcoin and Ethereum, are well-established investment vehicles, their histories are still too recent to guarantee investors of their long-term value. Regulation of cryptocurrencies and their widespread acceptance in the future are still too unpredictable to consider digital assets as safe and dependable investments. Long-term hodling may carry a larger danger to security. To prevent routine cyber theft and attacks, investors should learn how to secure their assets using the self-custody and privacy options at their disposal. Private keys, which are crucial for protecting assets, are more likely to be lost. After examining the benefits and drawbacks of day trading versus hodling, investors may decide that either method could fit into their overall investing plan. Many people do really combine day trading with hodling to expand their investments. Should you hold or day trade during a crypto winter? Even while bear markets might be frightening, many see them as opportunities to build larger portfolios, create plans for potential returns, and invest more time in research and education about investments. During a crypto winter, hodlers might wish to maintain hodling, and day traders should keep trading and profit from the probable increased volatility of markets. As emotions like FOMO are reduced, many pick up new skills and begin employing more technical indicators during bear markets. The emphasis might be on increasing wealth, having fun, and investing in oneself. Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.